Welcome to today's Corporate Venturing Insider series. I'm so excited today to have Sriram with us. Sriram, welcome.
Thank you so much for having me.
So it's been a while we wanted to talk and be having you on the podcast. Let's start with your background. How did you get into corporate venturing and now venture capital?
Yeah, so I spent my early days, 20 years of my career actually at Intel. So this was the time when Intel was really sort of the pioneering company in technology along with Microsoft. Intel really was building a platform, not just, building the core chip, but they were doing a lot of things. And Andy Grove, who was the CEO at that time, was very clear in his mind that, Intel actually has a lot more than just core technology or architecture. His view was that Intel succeeds when the ecosystem in which Intel plays in is successful, and people around that ecosystem were writing software and building products and other chips around that platform of Intel architecture. And to actually drive that, he had this belief that you really have to have a healthy ecosystem, and one of the ways to have a healthy ecosystem is to invest in that ecosystem. And coming out of that, came a function called corporate business development within Intel. And that was entrusted with the objective of, investing early stage companies and such. So I was very much part of that. I was in my first job. I was a technical marketing director supporting the executive office of Gordon Moore, Andy Grove, and Craig Barrett. And so I had many opportunities to sort of work very closely with them as they were just sort of thinking about all of this. There used to be a corporate VP, executive VP at Intel, Les Videz, who was employee number 3 at Intel. And so he had this function, corporate business development, and I was part of the original team as we were thinking through what Intel would do. And out of that came Intel Capital. So I was one of the early guys in Intel Capital. And prior to that, I was in software and networking and in consulting, actually. In the manufacturing industry. So it was a good transition for me to sort of be a technologist prior to Intel, looking at emerging technologies. And it was a perfect moment as Intel was actually exploding in the scene. And as they were trying to create this ecosystem, I had this unique opportunity to be part of it.
Very nice. I have to ask, because they are legends, do you have any anecdotes from Andy Grove, Les Valdez, which carries over to your investing career?
Yeah, well, there's so many things about Grove, Andy Grove, who is truly one of the iconic technologists of our time, of our generation. But more importantly, he's also an incredible manager. I mean, he could cut through the core of an issue, pretty sharp. I mean, it's like I haven't seen anybody else do it as incredibly as he was able to do it. And so maybe there's one small anecdote or a phrase that, of course, everybody knows paranoid, only the paranoid survive.
A great book.
It's a great book, and it's really right when you're at the top of the heap in any field or in any technology. And this sort of applies to not just companies, but even individuals. As you think that you're at the peak performance, when do you worry? Not when you're not at the peak performance, but you worry when you're at the peak performance. And that is so true of companies that get, complacent and don't innovate well. And there are so many examples in our industry, starting from Xerox to Nokia to Alcatel to AT&T and a variety of them. So that applies quite a lot. So that was his favorite phrase. But the other one that sort of sticks out for me is when you are in the industry where you just don't know which way is up, you have no idea if this is the right technology innovation or disruption, or is just a passing phase. And there are so many things that we've all seen in the industry. So the one phrase that Andy has used that sticks to me a lot is that he would say, before you pour concrete on strategies, let chaos reign. And then, if you really get it, reign in the chaos to your advantage. So it's sort of a play of words, and and he would use it a lot. Let chaos reign, and reign in the chaos, and that has served me very well, because what happens is, quite often we all make mistakes. In fact, we make more mistakes in some of the early stages. And it's really important to not have a point of view that is unchangeable. The adaptability quotient for an entrepreneur, and perhaps equally important for an investor, is probably the greatest skill as a corporate venture person, or for that matter, just as a VC. Don't get too attached to the idea of the technology, and really be nimble about changing your point of view is really what I think is all about. And that was his sort of mantra. So
That's really nice. I will double click on the technology side, and maybe we'll talk about WiMAX as well. But it's funny what you say, because it resonates with TDK CEO, Nobu Saito, who came to visit TDK Ventures team in San Jose last week. And he said he hates the word best, because it assumes you've reached it. And he basically said, I want better, every day better. And then he asked the team, please make more mistakes. But every time you make a mistake, the next level of mistake.
yeah, well, I would say one of the other aphorisms that I sort of keep in my mind all the time is that it's okay to make mistakes, just don't make the same ones.
Exactly.
Make new mistakes, and otherwise, how do you learn? So
Yeah. Now, Intel Capital is one of these success stories. And I think it's interesting to understand that the starting point was an ecosystem play. It was going beyond just selling a chipset, selling a few components, but really looking at the full ecosystem. Can you speak to why that probably was the right starting point to make a CVC be very successful?
Well, listen, a lot of what you stand for is based on where you sit. So in the case of Intel, Intel was truly becoming a monopoly power. It's kind of a bad word from an FTC standpoint, but that is truly what they were. I mean, they had so much control over the Intel architecture. And in a way, the way I think about it is that when do you define a company to be a monopoly power? In a simplistic way, I sort of think of it as if you are in an ecosystem where a whole bunch of people are creating products and technology in support of a core strategy that you're driving in the industry, and if the majority of the margin pool favors you at the cost of the others in the ecosystem, then you're a monopoly power. And in the old days, Intel had 60, 70% gross margins. And, in the PC ecosystem, you've had Compaq and HP and Lenovo and Acer and all the other OEMs. And, this little chip as a CPU that would go into the device that nobody ever saw would end up taking 80% of the margin of the whole system. So they were monopoly power. So I think it's important to recognize that when companies do, have that level of control, you have to ensure that the health of the ecosystem is very important. If that ecosystem is not healthy, you can't be healthy. And now you can fast forward and see that play out in the Apple ecosystem. Without the App Store, you could easily make the conclusion that the iPhone would not be successful. You could even make the same argument with NVIDIA. And you could say without CUDA and the CUDA ecosystem, the raw GPU, capability that NVIDIA brings may not be as successful. So I think success of the ecosystem is very, very, very important for a corporate VC. Now, to just sort of double click since you asked, Intel sort of looked at it in three ways. And I'll give you a simple sort of a analogy to make the point simpler. So it's sort of like, having a pizza. And the pizza has many slices. And each of those slices represent the different businesses the company is in. And the overall size of the pizza is the overall SOM, or SAM, the segment addressable market that you're playing into. So Intel had this analogy, which is we're in the business of doing three things. Number one, increase the share of the pie of the pizza in the markets that we're in. So increase market segment share, number one. Number two, increase the overall size of the pizza, which is overall available market
Yep.
that we can address. So that's the ecosystem point. Unless the ecosystem is successful and thriving and growing, you can grow. So that's the second point. And the third point was create new pizzas or new markets that you're not in. Maybe the markets are not even developed. So invest in creating new markets. So that analogy is very, very striking for most corporates. How does a corporate benefit from all the work that you end up through your corporate venturing activity if it doesn't improve one of these three things? It gives the company a unique advantage in the market that you're in. It helps the overall ecosystem grow, and it creates new paths or new markets for the corporate to get into. So that's sort of the justification for any company that has a corporate venture arm. If you cannot cater to these three things, then you're just a pure financial investor.
Yep.
You're adding to, your EPS and bringing, cash into your balance sheet. Nothing wrong in that, but one should not confuse that as being a strategic activity.
I love it. I think this pizza analogy is basically talking about how do you ensure your mothership becomes market leader? How do you have an exploitation mission to make sure that you grow the market?
Well, I don't know if I would use the word exploitation, but I understand the point you're making. Yep.
And then exploration is about new market.
Yeah, exactly.
Intel Capital was very successful in doing two things really well, exploitation and exploration. One was to work with partners and potential customers, potential suppliers of Intel as an ecosystem to help Intel grow that pie. But also exploration, looking at things that Intel was not involved yet, but might in the future. Can you speak to this dual mandate in a way and why it made Intel Capital so successful?
Yeah, so before I answer the question, I should confess that I've been out of Intel for a long time. So a lot of what I say is kind of the historical perspective of how it started. I left Intel in 2012. So it's almost 15 years since that time. A lot of things have changed, and Intel's position has changed and so on. In fact, the current CEO, Lip Bhutan, who obviously is one of the founders of Celesta, along with Michael Marks and Nick Brathwaite and myself. So I have some exposure to the current Intel strategy. But that said, I think the important thing to remember is that when you're investing as a corporate, to really sort of look at expanding the overall market or your share in the market or creating new markets, I'll give you a couple of examples of that. In the old days, before 64-bit computing came about, Intel Capital was formed in the mid-90s, and we were sort of starting to invest in, early stage companies. And then there was a strategic thrust, because you remember there was, the 386, the 486, the Pentium, and things were moving to 64-bit architecture. There's a lot of conversations about CISC versus RISC, and so on and so forth. So Intel made a decision that 64-bit compute was a very, very important architectural decision that was going to give Intel an advantage. It was high-performance computing. But Intel knew that you couldn't do it by itself. It needed the ecosystem to do it, because up until then, they were all doing 32-bit computing. And 32-bit computing naturally, extends to software and compilers and OS and all of that for that versus 64-bit. So Intel Capital took on the mandate to create a 64-bit architectural fund. It was called IA64. IA64 fund, there's a multi-LP, HP and Compaq and a whole bunch of other people were pooling capital with Intel as the quote-unquote GP. We didn't call it GP, but Intel was sort of the driver's seat of that fund. And they would go invest in companies that would sort of, raise the boats in sort of rising tide raises all boats. So if you actually make the ecosystem successful with a lot of successful players, Intel knew that it was going to benefit. And it just created this parade and managed to stand in front of the parade as the leader. So IA64 is a great example of IA64 Fund. Was a great example of how Intel started it. Likewise, later in the tenure that I was at Intel, we started the wireless fund. So, if you remember, 1991, 1992, people used to carry luggables, the compact luggables, which looked like a suitcase when you're going to the airport, was your compact computer. So it's completely impractical to think that you can actually use it as a mobile device. So Intel was actually going to completely change the rules of the game and launch something called, Centrino. And this was actually in 2003 when Intel was going to launch. It was called CMT, Centrino Mobile Technology. And it had three pieces. It had the core processor. It had the graphics, which was sort of an integrated graphics capability on chip or on a package. And then it had the wireless communication, which was Wi-Fi. For the first time, Wi-Fi was going to become native to the architecture of the mobile device. That was the first time people could even envision that you could have a mobile device which was light, compact, which was longer battery life, and you could actually connect wirelessly. And much before Starbucks and everybody else was there, that was the vision. So Intel said, "Well, how do I make it happen? I'm going to have these, these computers where they don't have anywhere to connect." So we launched the Wi-Fi fund for the first time. It was $150 million, and I ran that fund at that time. And the objective was to go enable the ecosystem to actually solve the problems that would prevent a mobile device from connecting. So things like, roaming and settlement and, single authentication, security, all of those things were required to be available in the market for Intel's core objective of having a device that could connect seamlessly, could become a reality. So Intel Capital did that, right? Intel Capital was the one that actually drove the mass adoption of wireless with Wi-Fi technology, in the market.
That's amazing, and I did not know that. So the wireless fund, the multi-LP,
and
IA64 fund.
The Wi-Fi fund was not a multi-LP; it was just an Intel fund. But that was the starting point, because if you remember, in those days, even Google was not really pushing for wireless in a big way, or mobile in a big way, so to speak. And you'll recall in the early 2000s, Google had this project in Mountain View, in right outside here, to actually allow for people to actually connect. So Google started making a big play in helping develop that ecosystem. AT&T started doing that. Comcast started doing that. And so today, when you have Xfinity, and Xfinity allows for you to connect wirelessly, the roots of that were, I should say, the seeds of that were sown by Intel in the late 90s and the early 2000s when it actually started.
It's truly remarkable. And that's more than 2 decades ago.
Yeah.
And it was really showing Intel having really good vision about how to build ecosystem with thematic funds, whether it was single LP or multi-LP, but trying to find the right partners for it. Now I want to talk about something which I know is you apply today at Celesta, which is your discipline about technology needs to be breakthrough, but that's not enough. Can you speak to your experience with WiMAX as a really good example in case where it was a superior technology and how it informs you as an investor today?
Yeah, I mean, it's a great case study of why falling in love with technology for technology's sake, can be at your peril. And that's it's a fantastic example for Intel. I mean, it's sort of very similar to what happened with VHS and Betamax, if you remember. I mean, I'm probably dating myself.
No, I remember well.
So not very many people probably know what a VHS is, and now people don't even know what DVD is because everything is online and streaming. But Betamax was a better technology.
Yep.
But VHS took over the market, and that analogy cannot be overstated. As it relates to WiMAX. But before I talk about WiMAX, I want to just sort of, take you back a little bit, because that same comparison applies even to Wi-Fi. Because in 1998, there was no Wi-Fi standard that was being contemplated, let alone solidified, for computing devices. There's no mobile phones outside of 2G, 3G, and GSM and CDMA were the predominant standards. But in the mobile device, as in a laptop or a computer, there was no wireless. So there were many choices. The choices were home RF, so what you use in your home for, or IR, infrared, what you use in your remote control to control your TV or whatever. That uses unlicensed spectrum. You could control another device. Why can't you use that as a mechanism for connectivity with a laptop? So those are two choices, home RF and IR. And then there was this nascent technology that IEEE was pushing. It was called 802.11. And so those are the three choices. And so Intel actually analyzed all of these things and made the right decision to say 802.11 is the best choice for a communication capability on a laptop, because it's high bandwidth, you want low latency, high performance. It had a way of driving it to low power and all of that.
Yep.
So that was the right decision from a technology standpoint, because Intel understood what is the use case. And this is to your point of understanding customer need ahead of finding the right technology. And then, as it often happens, when you get close to technology, you sort of think that, the customer behavior and the customer desires don't change, and you take into account a new technology on the basis of old customer behavior. And so Intel looked at, longer range wireless. And at that time, GSM and CDMA were the only two choices. And there was, of course, TDS CDMA in China, and there was a few other things in Japan that were different, implemented, WCDMA. There were a variety of technology architectures in wireless that were there. But Intel made a decision that for longer range wireless, you needed to have something that was a derivative of Wi-Fi, had similar characteristics, because Wi-Fi was widely successful, widely adopted, and said, okay, well, let's just evolve that standard and think of 802.16 as an evolution of Wi-Fi and call it Wi-Fi on steroids, so that you can have, now why do I have to be in a hotspot and only have wireless access? Why can't I have access while I'm, out in the remote place, in a rural area? I should still have, there's no Starbucks, I should still be able to connect. And then they asked the question, what if I wanted to be mobile? I want to be in the back of a car and I want to be able to connect it. So there was a decision made to say OFDM, orthogonal frequency division, modulation scheme, which is derivative out of the IEEE standard, was the standard that Intel felt was good.
Yep.
And we were all part of it. I mean, I was part of that whole effort. Professor Paul Raj, who's a Stanford professor, who's a sort of an iconic inventor of the MIMO technology, we all sat around and we said, well, this is great. And we made the decision. But what we didn't realize is that as superior as the technology was, the might of the ecosystem we had overlooked. So we couldn't, because for long-range wireless to be successful, you needed the seamless interoperability with the wireless carrier.
And the handovers.
Handovers and roaming and settlement and billing and all of those things, you don't have an infrastructure. And the only people that had it were the Vodafones and British Telecoms and China Mobiles of the world. And they had the old technology.
Different incentives.
Very different incentives. And here is a disruptor coming into the market, namely Intel and the computing industry, saying that, guess what? We're going to tell you how wireless should be done when wireless has been invented and built and successfully grown by the telecom carriers. So there was a mismatch.
Yep.
And that mismatch was not just a mismatch between the technology and what the consumer wanted. It was a mismatch between what the technology promised and needed to make it successful and what the existing incumbents were prepared to do. This is why, as a corporate, when you're investing, you got to make sure that your investments do not piss off the people in the ecosystem whose support and success is integrally dependent or at least connected with the corporate. So Intel lost that. Intel lost that because the carriers said, we're not going to do WiMAX, because if we do that, we lose control. And so over the top, services come, and we become, as they used to call it, the dumb pipe. If I'm just a dumb pipe provider, virtually speaking, there's no physical pipe, but it's the virtual spectrum that the carriers are delivering, I'm getting commoditized. So that lost the commitment that they would offer to WiMAX as a technology, even though it was a better technology. And so that's why they created something called LTE, long-term evolution in wireless, which is no different practically than WiMAX.
So repackaging in a way.
It's repackaging and understanding the need and the stability of the ecosystem, and hence LTE succeeded, and now 5G and so on and so forth. But this is the perfect example. There's a case study that a lot of people have written about, how not to lose the ecosystem. I mean, it's like, losing the forest for the trees, right? So Intel had the trees right, but it lost the forest.
I love it. That's a golden nugget. Now, if I think about how you invest today, that lesson, I'm sure, permeates to everything you do.
Right.
How do you identify that go-to-market challenge, that ecosystem, that incumbents who may be an opportunity or a threat to that startup's mission?
I mean, this is a completely different role that I play. At Celesta, after leaving Intel, I had my own small fund called Indusage. My other co-founders, obviously Michael Marks and Nick Brathwaite, they had a firm called Riverwood. And of course, Lebu had a firm called Walden. And so Michael and Lebu originally put that deal together, and it was called WRV, Walden Riverwood Ventures. And Nick was part of that as well. And then I came in later and sort of merged my activity about Indusage, and we were called WRVI, which is what Celesta is. But to answer your question on how we think about it, each person has, their own flavor of, how you make investments in the areas of interest that you have an expertise in, and all of that. But there are some core principles that I think apply to everything that we do at Celesta. We try to think of the core technology as a fundamental table stakes. There are great businesses in the market that may have minimal or limited technology or intellectual property. We don't go after those sorts of things as a first order, objective. We have made a lot of investments in the places where you can sort of think of it as higher up in the stack. You're not close to the metal, not close to the IP. We've made some of those. But our preference is to really look for what is the defensible technology or IP that can be scaled, and technology can be scaled. So that's sort of our first filter, if you will. Mm-hmm. And the second filter is, no technology. I mean, consistent with what I said about, Betamax and WiMAX and others, no technology by itself is going to be wildly successful unless you can figure out a use case, but perhaps more importantly, a financial and economic model that can actually pay for that use case with, rich margins. And if you cannot do those things, why invest in that? I mean, I might as well invest in real estate. I don't have expertise in real estate, great margins, but, what do I bring to the table? There's not something defensible. So I think we think of it in those three lenses. Core technology as IP, capability for, what is the use case or a problem that you're trying to solve? And can you make, nonlinear growth of margins? And if you can do that, then you're in a great place. So
I feel like maybe a way to frame it is beyond value creation, which every entrepreneur wants to do and typically do. The value capture really matters, and making sure you solve a real pain point that people are willing to pay for that solution. Without that, you cannot scale.
Yeah, that's exactly right. And I think as a corporate VC, especially the likes of, maybe Google or Microsoft or Facebook or perhaps, even the new Intel, you have a platform, and your platform is technology, reach in terms of go-to-market, and diffusion of whatever technology that's in your platform. And then, of course, you have a brand and trusted customer relationships and all of that. So as a startup, that's very valuable. So, and as a corporate VC, like yourselves, you can sort of dictate the terms with the startups, because implicitly, the startup would think of you as a go-to-market accelerator or a technology enabler to amplify the technologies that they have. So, and of course, you're going to be able to open doors with new customers and all of that. So I think as a VC, we have some of that. We don't have the core technology platform. That's not the business we're in. We have access and we have customer relationships. But then again, you need, going back to my earlier point about the ecosystem. In our world, that ecosystem is trusted fellow travelers or co-investors. We can't carry the load of making a company successful by ourselves. I mean, we don't have the monopoly of smartness. There are a lot of other smart people, a lot of better access, So to me, personally, when we invest in a company, I always look for who are the people that have shared vision of that company's success, that are willing to put money on the table, that are willing to put their name next to that company, and be prepared to do the hard work. One of the most common mistakes that a lot of people make, and we've made some of them ourselves, is to get into a situation where gnarly problems have to be solved in a company, whether it's in the technology roadmap or IP strategy or go-to-market or people. You're the lone voice at the board fighting for it. That leads to dysfunction. So if you have a bunch of other people in the boardroom with you to actually have a healthy debate, have opposing points of view, and people willing to do the hard work, the chances that the company will be a healthier company is higher. So for me, I think having good, solid co-investors is important. So in that respect, we don't optimize for, we got to have the maximum ownership in a particular company. It doesn't matter. To me, for the monies that we're putting in and for the ownership that we have, do we have the right people around the table, including the management, that can actually make it successful? So that's kind of the...
I nearly feel like the pizza analogy would probably work here, which is if you want to have a dream syndicate, you need to give a few pies to more people. As long as they believe in the mission, they can accelerate or de-risk the journey of the entrepreneur.
Yeah, I think that's it is true in not only the way we invest, it's also true in the way we think of ourselves as a firm, because we have Nobel laureates. One of the Nobel laureates in biology was a senior advisor, at Celesta. We have a Marconi Prize winner, in wireless, Dr. Paul Raj. He's a senior advisor. We have a chancellor in University of Montreal, who's a semiconductor guy. He's a senior advisor. So I think it's important to have, as a firm, which is same is true in terms of the board composition in a company, where you have to have people that are complementary and that can enhance the value of the company or of the firm, and it doesn't all have to look the same. And
it
so
cannot be the same.
It's exactly. It cannot be the same. We all bring different skill set, but there has to be something that is core. That's that connective tissue or of the binding that happens, and that has to be the belief in strategy, the belief in the core mission. What are our core principles? What do we care? I mean, a lot of people say that we're founder friendly. That leads to bad behavior sometimes, and bad outcomes. But can we be transparent with the management and say, you're a great guy, you're the founder, but you're a lousy CEO. Let's enlist that entrepreneur to support that idea and keep that person in the role where they can have the maximum output. And we have many examples of that in our portfolio, where the founders have come to us and said, I understand technology, but I'm not the guy. And so we changed the management. So that's important.
Actually, being founder friendly for me is not to be nice or kind. It's about helping them be successful. It doesn't mean that the founder needs to stay CEO forever.
Exactly. In fact, I'll tell you this, somewhat contradictory to what I said earlier about Betamax or YMAX and all of that, is that if you look on average, if you look at our portfolio, and I would contend it may be true for a lot of other investors as well, companies fail not because it's bad technology, it's because of bad execution or bad management, and that's true for us. That's true for many people. And I like my partner who says a very interesting comment, which is companies go out of business. Usually they'll tell you we ran out of money, so we ran out of business. They don't go out of business because they ran out of money. They go out of business because of the reasons why they ran out of money.
Exactly.
And
what's behind that?
What's behind that? And if you made wrong decisions and you spend SG&A completely out of whack relative to where you are, or you spend too much money on R&D when the market is not ready, and so it's the reasons that you ran out of money that made you go out of business, not the other way around, right? So I think you have to be really thoughtful about that.
So I want to double click on building that great syndicate. And I think what you're saying is basically a very strong, aligned why towards the mission of the startup. You have this beautiful venture point of having been in a corporate VC, now in a VC. How do you decide which corporate VC is the right corporate VC at the right time for that given startup?
That's a very, very good question, because there used to be a time when, in the early days, where everything was run out of Sandhill, or most of the value creation occurred by the financial VCs. Intel Capital did like 1,000 deals, and there are so many companies. So when you're that big, you have your hands on the pulse of so many things, and you have the sensors to know what's happening in the market. And there was a lull period where, post the dot-com bubble, when the corporate VCs went out of, vogue. And now they're back in, huge success and traction and all of that, thanks to, companies, creating incredible value for themselves, multiple trillions of dollars of market value created by some of these companies. So you have, NVIDIA and Microsoft and Google and others. So their platform has expanded. So naturally, and they're spitting out so much cash, so they can actually, for them, there's only so much cash that they can put into their own business to get the uplift on their margins. So they have to get other fast-growing areas. So corporate VC, this is the golden age for corporate VC, in my view.
I agree.
And so where does that leave people like us, who are very focused, very targeted, specialized venture capital firms? Because that's another point, because VC's early stage venture capital has also changed. And now you're doing seed rounds at $50 million. It used to be $500,000.
Yeah.
So the venture capital model has also changed. So in that world, how does a VC decide which is the perfect corporate VC to work with? As I said, to have the composition on a board, and that's a tough decision. And it goes back to my pizza example, because you have to ask the question, what is the corporate VC's motivation?
The why.
It's the why. If it is to figure out and use corporate VC as a sensor to know what's going on in the market so that they can be better at what they do, that's one thing. If you want to have that sensor tell you, early stage companies, that you can acquire, that's a different thing. If you want to, prevent an early stage company from coming up with the technology that limits your monopolistic power, it's almost, it's a very different motivation.
Yep.
So you have to really understand what is the motivation of the corporate VC before, pure financial investors can pick the right one. And what happens quite often is that the startups are like bees to honey. They get naturally attracted to brand, heft in the market, cash. Sometimes some of the large corporates have scant respect for valuations. So it's like sugar, right? You give you give someone a lot of sugar.
Sugar crunch.
That's right. I mean, you get a sugar high, and then you get all these valuations out of whack, and then only to find later you got you have a problem in your hand.
Yep.
So I think these dynamics are very, very important, and fortunately for us, Celesta actually has one of the largest roster of corporate VCs that are partners with us, and there are investors in our fund, and they're also co-investors in many of our deals. So we get to see how they participate. But I don't mean to imply that we're some large, venture capital firm. We're a small firm, but we're very focused and very clear about what we try to do. We make mistakes, and we course correct and all of that.
But you're maximizing your sensors, you're maximizing the network of trusted investors, and you understand their why.
Yeah, understanding the why is perhaps the most important thing. Any startup should be doing that. They should be asking the question, what is the right point in time when I need to have a corporate support?
Exactly.
Getting it too early leads to, early sugar highs. So you got to be careful about that.
Yeah. No, I think it's a golden nugget. Entrepreneurs need to ask the questions of why would the CVC want to invest and make sure it resonates, and probably the superpower match what they need at that point in time. We're getting towards the end of the interview, but I want to ask you about the corridor of US-India. You have put this IDTA initiative, which is huge. I want to hear about why are you bullish about it, and do you think that deep tech in India is at the inflection point that I think you and I believe?
Yeah. Well, I mean, I want to make sure that it's the right question, but you have to, I don't want to sort of agree with some of the premise that you're implying, because I think India is a very complicated market. It's a huge market, and there's lots of appetite in India for building, entrepreneurial projects. In the old days, it used to be the large family houses, the Tatas and Birlas and Reliance and Bhartis and others who actually were the ones that were making a lot of the investments. And in the last 20 years, you've seen lots of young entrepreneurs build very efficient business model innovation companies. And going back to my comment about sugar high, some of them had huge sugar highs because they made huge value appreciation. The market actually was attracting monies from the likes of SoftBank and Tiger and a whole bunch of people, and that was a period, right? And then comes, starting to 2018, when people started sensing that this whole BPO, consumer internet, shared economy, enterprise software services play that India was very good at may have its day of reckoning coming. And so the market sort of, warmed up to core technology, because everybody started asking the question, when you have, Google and Cisco and Qualcomm and all of these players that have tens of thousands of people in India working on hardcore technology problem, you still couldn't point to, one or two or three hardcore IP-based deep tech companies. And they said, why is that? So, that was a reckoning that I think the government actually saw. And the government made this effort to actually launch a fairly large sort of a sovereign-backed fund of fund and direct investing and all that. It's called RDI. And the government actually invited us to see how we can be helpful. And that was the starting point. Now, that said, the market has not solved a lot of the underlying problems in deep tech. I mean, you have very limited number of good, solid deals. I'm concerned that there is more capital available than the quality of deals that are there.
Okay.
That's not to say that that can't change over a period of time, but if you are not careful, You're going to have too many people putting too much money into few places. Supply demand, valuations are going to go up. So many of them are going to fail. So if you don't solve the underlying talent and technology and execution and management capabilities, just throwing money at the problem is not going to solve it. That's number one. Number two, you can't have just one or two people do this if you don't have a healthy ecosystem. And it goes back to my point about, co-investors and corporates and others. So this whole idea of IDTA came about as a result of the government asking a bunch of us, from the industry to support their objective of, providing an impetus to deep tech and how the industry can help. And the industry said, well, instead of us just trying to do it one-off, let's try to have a coalition of the willing that are willing to commit. And this IDTA has, NVIDIA and Qualcomm and Cisco and a whole, Lam Research and Applied Materials and a whole bunch of corporates, in addition to financial investors, coming together and saying, how do we ensure that we have best known practices? From a startup standpoint, what are some of the regulatory challenges that exist? What are some of the capital formation, rules that the government needs to change? So the idea of IDTA was really to be a, open consortium, and by itself, it was intended to solve the ecosystem level problems. And India has done that in software very, very successfully. It was called NASSCOM. And you could argue the reason why the Indian IT services industry became as successful as it did was because of the efforts of NASSCOM. So IDTA, hopes to, be like a NASSCOM for some deep tech thing. So by itself, it's a necessary thing, not sufficient.
Not sufficient.
So a lot of us have to be looking at our own core strategies and seeing where do we want to play and be disciplined about it.
So one more question I want to ask is about the envy that sometimes CVCs have about VCs and VCs about CVCs. What it is that when you were at Intel Capital, you really leveraged, which now as a VC you don't have anymore.
Yeah. Well, I think a lot of people have different points of view about what is a great, makeup for a good VC firm. There are different points of view. There's no one thing that's right. I'll tell you how we operate. I think a investor in a VC firm like Celesta really looks for what can you do between the time you invest and the time you exit. What is that operational capability that you can bring to the company that benefits that company and increases value? So operational expertise is the tip of the spear for us. It's not availability of capital. It's not, who we know. It's really what can you do based on firsthand experience that we've all had in scaling technology to a successful, market outcomes. So, Flextronics, Michael and Nick, built it, just outstandingly, right? When contract manufacturing was not even, in its infancy, company was, $8 million or whatever. And by the time they left, it was like, $30 billion, right? And Foxconn happened after, right? And you could argue that without Foxconn, iPhone wouldn't have happened.
Yeah.
So I think scaling technology and operational involvement is the most important sort of superpower that we would like to think we have. The other thing that I would say, what you measure improves always. And like, stand on your weighing scale every morning, you lose weight. There are a lot of other things you have to do, but the fact that you pay attention to it will make a difference. So in the investing space for the VC, having regular sort of financial monitoring, regular evaluation of IP strategy, regular evaluation of operational metrics, all of that, is important. It's not enough to just go to the board meeting and look at the presentation and say, okay, well, the company's doing fine, or, oh shit, they're not doing fine. Yep. So you have to really, this is hard work. It's kind of like overnight success in 10 years, right? You have to continue to grind it. Now, in some places, in the corporates, you don't have access to all the resources that you need to make a company successful. You're dependent on other business units. You're dependent on other priorities and, other things. that you don't directly control as a corporate VC. And so you spend a lot of energy fighting battles internally to align those resources together to be able to, provide it for the companies. VCs don't have that. I mean, I have, 10, 20 people in the firm, and we're a call away. But, if you end up having to spend 3 hours coordinating meetings in the corporate VC, that cadence of involvement is not going to be successful. So there's these differences, but there are other advantages. So,
Do you want to speak to the other advantages?
well, I mean, in the corporate VC, as I said, scaling is much easier. Whether it's scaling of technology or diligence, for instance. A company like TDK or Google or Intel or any of these larger companies, I am sure there's no new technology that a startup might come about that someone in a large corporation has not looked at or hasn't played with or something. So finding diligence support early on for a VC may be very difficult, but for a corporate, it's not. Customer access, you're in the business of selling to large customers. So for a startup to actually get connected to a bunch of the customers that the corporate VC has is much easier than for a VC. So, these are very important things. IP strategy, most corporates have a very well-established process for how to file IP, how to, monitor IP or monetize IP. That can be a benefit for the startups. VCs don't have that. So I think these are all things that I think there have to be a right balance.
No, it's very helpful. Now, we talked about being on the board. I've seen so many different board member style. Can you share maybe to the audience, people who are in CVC or thinking about being in CVC, they will be on the board of startups in the future. Please don't be that type of board member. What are the things that you don't want to see in a board?
Well, how long of a list do you want? Well, I think, and this is something that's really stuck with me because a lot of people show up to the board meetings, at the board meeting, and they are looking at the numbers or the spreadsheets that are put up on the screen, and they make conclusions, they make recommendations. It's kind of like, there's this famous line in the movie Amadeus, which I don't know if you've seen, about Wolfgang, Amadeus Mozart. And, Mozart is performing, I think it's Marriage of Figaro or one of the things in the Vienna orchestra, in the symphony. And the archbishop or the duke shows up and he says the opera was perfect, except it had too many notes. And Mozart says, okay, what do you want me to change? He says, just remove a few notes and it'll be perfect. So a lot of VCs say that. Improve margins, your business will be great. I mean, that's like, stating the blindingly obvious. Okay, why are you coming and telling me something that, I don't know how to do? And you as a board member have to help me figure that out and not just assess the diagnosis of the statement of the problem. So a lot of people that do that, I am like, stop, And then the second thing I'll tell you is it goes back to the same point that my dear partner, Nick Brathwaite, says about why companies fail, not because they ran out of money, but because of the reasons why they ran out of money. Same is true at the board. When an entrepreneur or a CEO is struggling, there's some underlying reason why he's struggling. Maybe it's a family issue. Maybe it's something happening in his private life. And there's no bright line as a CEO between private life and the startup life. And board members that are able to seamlessly transition between these two things and understand what is motivating that entrepreneur, you will never get to the bottom of the problem. And if you know the bottom of the problem, you can find a solution. If you don't, you'll say, okay, let's just change the CEO. And there may be something that you're completely missing. So I think these are two really important things that I think that I look for, in a board, whether it's a VC or a corporate VC, doesn't matter.
And in a way, it comes with prepare in advance, make sure you come with tangible offer to support. and insights.
Well, the important thing is the board meeting oftentimes is conducted as a information dissemination exercise, which is suboptimal. And the board members that show up with that expectation are really suboptimal board members. The board is intended to be a discussion forum. If there's material that's prepared, it shows up in your inbox a week before or a few days before, read that damn material, understand the issues, and have a discussion. And when management doesn't do that, they're expecting approvals and this is my annual operating plan. The annual operating plan that is presented at the board should never be the first time the board members see it. It should always be the last time that they see it at that period, if you will, because you should know, what the management is grappling with. What are the different choices that they're trying to optimize? What are they trying to maximize in that period? And have that discussion outside of the board meeting, and have the board meeting to review the annual operating plan as a way of, collecting more ideas about how to improve the business. So these are all sort of, board, one-on-ones, if you will. But it's strikingly disappointing to see a lot of companies don't do that.
I love everything you've said. I think that is a discipline we should see and expect from every board members. And sometimes people are new to it and they don't have the apprenticeship around it. So your feedback is really important.
Yeah. Well, I mean, listen, I think while I was at Intel, Intel's overall portfolio, if I remember it right, was about 400 companies, in the 2010 timeframe, almost, 16 years ago. And it was valued at, probably, $6-7 billion.
Yep.
So, it's not small numbers.
It's not insignificant.
It's not insignificant. And it is so easy to get caught up in that and lose the nuggets of real value accretion and real lessons out of it. And so I think it's an opportunity for other corporate VCs to really sort of look at, what has worked. I mean, Google has done an amazing job.
Yes.
Google Ventures or GV or Google Capital, and there are others.
Thank you, Sriram. I really appreciated everything you shared today in the Corporate Venturing Insider series. And I think it will be helpful for CVCs, VCs, but also entrepreneurs listening in, knowing what questions to ask and how to prepare well. Thank you.
Thanks for having me.